past companies and to find out which ones were really good and like who got funded and have they had a good exit and blah, blah, blah. And we started with about 200. Okay. We already knew what the story was. We already knew, were they successful or were they not? And
we all exit our company eventually. The question is, will it be on your terms or someone else's? Strategy matters. Timing matters. The right partner changes everything. Brought to you by Meritage Partners. Here is your host, Brian Franco, author of The Inevitable Exit. This is the M&A Guy Podcast.
Welcome back to the M&A Guy Podcast. On today's episode, we're going to be unpacking a lot of really powerful information. Today's episode is titled Capital, Control, and Culture, Building a Business that Attracts Smart Money. So let's dive right in. On today's episode of the M&A Guy, we're going to dive into some very important information and help you reframe how you think about your business. Today's title is Capital, Control, and Culture, Building a Business that Attracts Smart Capital. And to help me highlight this and talk about the details of what that looks like, my guest is Kent Kubie with Kubie Kai. You're going to hear a lot about him, the work he does, and the work he's currently doing with Meritage Partners and our clients. So with that said, Kent, thanks for joining. Thanks for being on.
Thanks, Brian. I appreciate being here. Great setting.
Great setting. Beautiful weather. You can't complain, right?
So we call it in Austin like a Chamber of Commerce day. It's like perfect. Like if you visited, and I know you guys are coming out in a couple of weeks. Yeah, that'll be fun. But yeah, and you're coming out at the right time. Perfect. Because March is like the perfect month.
Is it? Okay.
Yeah, because it's not too hot, not too cold. It's,
I'm happy with that.
Yeah,
I'm
perfect.
Well, so Kubie Kai, how did you come up with that name? Give us the background and the story of what you built here.
Fantastic. Yeah. So that was pre-AI chat GPT kind of stuff, right? Which we do a little bit of that work in the AI space. And that's kind of how the AI of the Kai part of it kind of comes into space. But I actually came up with the name, probably sitting around in my office for hours and hours, just trying to figure out like what to call and I didn't want to have something that was just like so generic, like, profitability consulting or something like that. Right.
Not a bad title.
Not a bad
tagline.
Better tagline. Right.
Yeah.
So I did martial arts for a long time.
Okay.
And so, I was in that, kind of in that culture and that community for like probably over 30 years.
Oh, wow.
And so that really, that idea of, what the definition of Kai is really kind of a community and, support and helping stuff. So that, bled into that really well. And it just kind of felt natural. And then the play on AI was right there too. Correct. So like it just kind of came to me. So that's kind of how the company got named. And
awesome.
And then, in like the work that we do, like as you kicked off the podcast, where it's really around, the culture piece of it's huge.
It is.
And then that backs into the numbers, right? You probably see that every day.
We do, because culture feeds a behavior really in amongst the team, amongst the Kai.
Yeah.
And we always go back and forth on this topic is what comes first, culture or systems, right?
Right.
And if your culture really appreciates systems and accountability, then that's the culture I think you need to have.
Right.
Because if your culture is to be anti-corporate, anti-systems, anti-accountability, it's hard to really measure and improve the business.
I'm smiling because we have a client like that today.
Yes.
And they had a near-death experience.
Oh, wow.
And now they're kind of back.
Yeah.
But it was, they wanted a fun culture.
Okay.
Right. And they're in an interesting space in the security space. They have they wanted a fun culture, but the accountability side and the measurement side just
wasn't there.
Yeah.
Well, let's talk about the world of private capital markets. I'll take private equity because that is a phrase and a name that people are familiar with.
Right.
But private equity, private capital isn't just about capital, right? It's not just about deploying capital. It's really about confidence. Is what they're aiming for. And so in your experience in martial arts, that accountability that you've had in that Kai, you generate and produce and confidence in your abilities and capabilities. And so I think the misunderstanding typically is, when we see headline deals out there in the news, it comes down to, it's like, this equity investor did this deal and it was valued at this amount, right? But I want to bring us back because it's not just about the hype. Private equity and private capital is not just investing in hype. They're really looking for clarity, predictable revenue streams, and leadership depth, right? Because when you think about transferability, which is something that's going to occur at some capacity,
right?
What's going to transfer and what's not? And it could be relationships, it could be relationships with customers, clients, vendors, suppliers, so on and so forth. And but that predictability allows them to underwrite because they're underwriting to risk.
Right.
Okay. And so predictable revenue streams like software companies is pretty easy to underwrite. What's your MRR? What's your ARR? Right. And in 2026, I would say this year, the biggest differentiation that we've seen, because private equity groups are holding investments longer. Some see this as a doom and gloom, but you have to remember we had just a few years in COVID era where things changed. Some businesses doubled in size. Other clients were cut in half or shut down their companies altogether, right? And so there's no surprise to me that the hold period is longer. And it really comes down to an evolution of how these transactions are financially engineered. And so, but when I think about here in this year, investors are being more intentional. And they're being more focused in and around business systems, continuity, predictability, and those things.
Well, that's what they should be focused on.
Correct. and their eyes are open, and they have to listen to that now.
Right.
And we're seeing more of this occurring in deal making. Hence, we're going to be out in your neck of the woods. We just wrapped up a transaction this week, $60 million transaction, which is great. Everyone's excited, high-fiving. In fact, they're meeting today in Austin, just going through their strategy and their plan. But in your work as an entrepreneur, as a strategist and the founder of your firm, you've really been focused on leveraging systems and inclusive in that is AI as well.
Correct.
Right?
Yeah, it's there and you can't ignore it.
You can, but it'll pass you by. Right?
Well, I noticed when I was driving in today, there's a car dealership across the street. I'm going to go check that out a little bit because there's a couple of cars there that would be kind of fun to have.
They would,
and I'm sure one or two of those brands go really fast.
They do. Yes, I know exactly. With Ferrari dealerships and Porsche dealerships and everything across the way. And so I want to dive into some hot swap questions and kind of pick your brain, and also I'll share some of my experiences, but. When you think of, we're at this time where AI is empowering humans, empowering companies to do more, right? And I want to tap into how this is really improving or discounting multiples or valuations. And so from that perspective, Ken.
That's a good tee up.
Yeah. So from that perspective and your perspective and the work that you do, how are these systems and how is AI, how's that being evaluated by investors in the marketplace?
Yeah, so that's a great question. So I'm gonna answer the question probably a little, and I'm gonna take a little trip to get to the answer to that, because when you look at the deployment of capital, and I read an article, it was a LinkedIn article probably 6 weeks ago, and I won't mention the venture firm's name, but they've been around and they're one of the top they're top pyramid kind of folks. And one of the investment partners said, we've deployed, over, I'm just going to round it to over $200 billion in capital with less than 10 superstar exits, and if you do the math on that, there were like how many people died, in the, in the waste of $200 million. Or $200 billion. It was billion. That was, I had to read it twice. Yeah. It was like, wow, So we, my partner, Brian Eckert, and I came from kind of the healthcare space, right? So he's a turnaround guy. Yeah. So he sees things differently. I'm a marketing and sales guy. Correct. We both technology guys. So the AI thing really kind of plays into the space. But we really started to embrace AI, and AI being not the end all be all, but it exposes things that people can't normally see. And I'll give you a for instance of that here in just a second. Because we do this like once or twice a week with potential either founders looking for capital or people that want to deploy capital. Like, we're looking at these guys, we're not sure. right?
So you're sitting on both sides.
We're sitting on both sides, yeah.
With the operator side, but also on the underwriting side, and investors sift and sort through what's there and what's not there.
Yes, yeah.
Okay.
Or here's some questions to ask, right? This is the pitch deck. What's the pitch deck do? But anyway, we were about a year ago. We were working with a couple of founders to help them, raise capital, right? And just through connections and stuff like that. And we would look at pitch decks and we'd ask questions, and it's like like somebody go like, well, here's our use of funds. It's like, okay, so you've got, 50% of it's a software. This was a software company. 50% of it's in development, right? Which makes sense. Was it 29 or 30% was in executive salaries, and the balance was in sales and marketing? Yeah. And like, no. That you can't show that slide. Yeah. Like, why? Because no one's going to give you money to put in your pocket. Right.
Same thing with marketing.
It's exactly like the marketing piece needs to be a lot bigger.
Correct.
And your take home pay is not $300,000 a year. Okay. It should be 100, right?
Correct. Yes.
Right. And the rest of it until you perform, because that's where the paycheck comes. Yes. And they're like, well, we got to live. I'm like, no one's going to subsidize your business, right?
Or your lifestyle.
Right? So you have to figure that out. Yeah. But so what happened from that is we had talked to 3 or 4 venture capital firms, and they all passed. We kind of knew why, but we went back and said, hey, we're just doing our own research here. Like, why didn't you, just between us kids,
like an exit interview,
why didn't you fund? And they're like, they have no financial acumen, or they have no business acumen. And these are people that they look like good operators, correct, right? Correct. But at the end of the day, the proof point was there. So we interviewed about 12 venture firms. Okay. And we said, we asked, how do you guys do this? And what does a fund look like to you? Okay. And they roughly, every one of them said, if we have 10 companies in the fund, we have 1 that does pretty well. Okay. We have 6 or 7 juries out, don't know. Yeah, and then we have 2 or 3 complete dumpster fires. Yeah. And it's like, okay, and we started to ask about the dumpster fire stuff. It's like, well, why did, and that's where every one of them said business acumen and financial acumen were missing. And we were like, how did you not see that? Yeah. Right. No. And then, and it was consistent. And then if you look at the statistics in venture, in private equity is probably not as bad, but ventures, right. VC is crazy, is 75 to 90% of venture dollars get absolutely burned with no result, i.e. the success rate's pretty bad, right? Yeah. Which, and by the way, everybody that we talked to basically mapped back right into that story of, we got 1 really good one, and the rest of them are bad. There was a company in Nebraska that we interviewed. They've done 30 deals. Okay. They have 1 success.
Wow. Well, it comes back to the point that, investors aren't just looking for growth. Right. They're looking for insight into these companies. And the more that they could understand, the more insight they have, which then, to your point, into your exit interview with these groups that passed, they ultimately passed because of the financial acumen or the financial cleanliness of what they had presented or prepared. Right. And when they see that, they do see some of that could be cured, yes, with a capital partner. Right. But if it's at a point where they see it as a barrier of entry or a risk, it's right.
This goes back into your earlier comments about systems and culture.
Yes.
Right.
Yes.
These guys had neither.
Yeah.
Right. They, that was a telltale thing. So as we started to do this, we would send us the pitch deck. Let's see what it looked like the people that you funded, because we're trying to figure this out. Brian, my partner in his infinite wisdom, back in the summer, started to tinker with. We use ChatGPT, right? Yeah. That's our preferred platform. We use a couple other ones. That's that's the one we're comfortable with. We started evaluating past companies and to find out which ones were really good and who got funded and have they had a good exit and blah, blah, blah. And we started with about 200. Okay. We already knew what the story was. We already knew, were they successful or were they not? And we built an algorithm and we tuned it for failures, right? So we put 200 people in it and we tuned it to fail. And, let's say there were, let's say there were 20 that were successful. The other 180 were bad.
Yeah.
It predicted every one of the failures from a pitch deck. So we started to develop this more and more and more. Now we've trained it with over 1,500 companies, case studies where we knew the answer, right? So we tuned it from there. And then now we turbocharged it. And now it goes out, and every time we get a deck or an investor brief or something like that, we run it through this thing, and it goes out and it hits about 250 other data points.
Yes.
Because it's all available. And now it gets really, really interesting. And now it gets back into the systems part of it. Because now we'll look at somebody and they'll say, like, we want to get funding. And it's like, well, give us your deck. We're going to give you a Roman vote up and down pretty quickly.
Yep.
You know, and
that's keep going. This is powerful.
Yeah. So what happens with what we've done now is we can take the deck or any materials that they have, and we score it 1 to 10. It's pretty simple, right? We haven't seen fundability, right? So we're going to give them a fundability score at the very surface level, at the high level.
You simulated it through case studies, taught the AI to
look
for specific elements.
Yes.
Whether it's present or not present.
Yes.
And I just want to speak to the audience, because what you're hearing is clarity is ultimately the value driver. If you lack the clarity in your company, in your pitch, that is where investors are going to see actual risk, or they may perceive risk just by looking at this data. And to your point, and we see it more and more, investors are not using humans to evaluate these opportunities. They're using technology.
Right.
And so if technology like AI can't identify the clarifying points in your business and your strategy, they're going to walk.
Yeah.
Right. They're going to walk.
Yeah.
And that's the punchline.
And that's what we see when we do the evaluation.
Yeah.
And then it breaks it down systematically, right? So we kind of have an offering that we call it sextant. You know, so we're in a perfect space for that, right? And if no one knows what that is, it's a medieval navigation device, right?
Yeah.
And when you have something, like you got the harbor here, right? So like if you were, like these guys are putting around here, and it's pretty easy, but like, if somebody had an oil tanker that they were trying to dock here, they have to have a harbor master, they have to have a tugboat, so they need guidance for that sort of stuff. So when we do the evaluations, we see the systems or lack of systems, the lack of the discipline or the culture to actually pull it all together, right? And so that's sort of like, so we're kind of the harbor master with these guys. When we identify, okay, the channel's deep enough here to run your boat through, that's good. Don't go over there, there's rocks. And bad stuff happens when you hit rocks. Like,
that last time I checked, it's pretty bad.
It's pretty bad. Yeah.
Or a bridge
or whatever. Right. Or a sunken something, you know, but as we go through the evaluation, then we see everything. We identify the gaps. And so if you're like for you guys, like we would do this for somebody, right? We would run them through this thing, and then we would go, this is pretty good. By the way, when we do the initial thing, we've never seen anybody get more than a 7.
Okay.
We see a lot of
out of 10.
Okay. And 6 plus, pretty good. There's a couple things you can tweak.
Yeah.
We've never seen anything beyond the 7. We grade hard. Heard the algorithm rates hard. See lots of 3 to 4 stuff. And it's usually in inconsistency. Okay. It's usually in lack of systems and the discipline to actually, in the evidence that comes with disciplines to do that. Because, in my martial arts experience, you could test, but you may not pass because you don't know the material or the technique, right? I mean, they won't let you be a black belt. At least they used to not let you have black belt. You can't pay for one now. But you used to actually have to, like, it was tough, right? You had to do like 100 elbow push-ups or something. It was crazy stuff like that. It was a long journey. It was a journey.
7 years?
It was a long time. It was
for a black belt.
It was, when this was in the 80s. And this was probably, probably took me 4 years.
Mm-hmm. Yeah.
And then, to get my next one was another bunch of years,
Yeah.
But anyway, so
you have to master the skill.
You got to master the stuff. So you have to master your business kind of in the same way, right? So back to the systems piece, that's something that it picks up on that stuff.
Good. Yeah, because the theme of what you're talking about is visibility. We're talking about automation. We're talking about forecasting, efficiencies, finding those gaps.
Right.
Because, in these pitch decks, we see a lot of them as well.
Right.
And, they think they believe truly that they're hitting on all the right points,
Oh yeah.
which mostly they are, but it's what they're not saying. Right.
Right.
And those are the gaps that you're describing.
Yes.
And those gaps are ultimately driving decisions on where capital is being deployed or not.
Right.
We agree VC is a very different world.
Right. Right.
Private equity has a very different playbook and strategy when it comes to underwriting. And so that visibility provides for predictability because they could forecast. And,
right.
I always say, you as operators or business owners, you built a machine.
Right.
If you stick $1 in one side of the machine, what comes out of the other end?
Better not be 85 cents.
It better not be, it better not be a negative number.
Yeah.
Or else, this is the issue.
Right.
Can we talk about, I'm going to correlate for those tuned in scaling.
Okay.
And I want to like it enterprise value.
Yeah.
Right. So you see where I'm going.
Hot topics.
Two hot topics
Yeah.
because, we're constantly focused on revenue.
Right.
Scaling revenue. Okay. And
everybody loves to see revenue.
Everyone loves to see revenue. I mean, who doesn't want revenue growth?
Yeah. Right.
But the issue is, what is that really doing to enterprise value in the context of capital being deployed? Because they don't naturally correlate. You would think they do. I mean, because if you're sticking in, if it costs you $1.15 to earn $1, that's a problem. Right. Because you're at a loss in the scenario.
You can do that for a little bit.
You can do it for a little bit.
Yeah.
But you have to have a roadmap. It has to be able to, we have to be able to articulate how you're going to get from where you are to a critical mass, or maybe it's market share that you're seeking. Right. Then it has to produce profits at some point. Right. Right. Yeah. Or else this is where deals go to die, so to speak. Right.
Yeah. Absolutely.
So from your experience, and I'll share some of mine, but founders love top line growth. They just love it. And it's
sexy to talk about.
It's sexy, but it's in a lot of situations, it's a false sense of satisfaction, a false sense of accomplishment. And, but investors, as to the theme that we've been talking, they love predictability. Right. They love data. And if you're lacking one or both, it's going to be hard for them to see beyond how they're underwriting. And there's human intuition here still involved.
Oh yeah.
Right.
And by the way, human intuition AI cannot replace that.
No, it could influence the human, yes, but human intuition comes from experience. It's like wisdom. You can't learn wisdom by reading a book. You have to experience life.
You have to experience it, yes.
You have to go through humility, and you have to do all of that to gain and earn that wisdom.
Absolutely.
And so,
well, that's when when you're on the planet for as long as I have been around, you've had some of those experiences, but you're really driving into something I think is super, super critical that you can't see from a deck, you can't see from an investor brief, which is what are the systems that are available to that company that they've deployed to actually do that. So we've done some kind of pro bono work, which we don't like to do anymore, but this was just kind of like to get our feet wet with a private equity firm out of the DC area. Okay. And they had a company that they bought that was in Houston. And in one of our domain spaces, right? They had, I won't get in too much about what the company is and does and stuff like that, but they focus on the healthcare vertical. Okay. And Brian grew up in the healthcare space, and I was in the space for probably been in there 26, 7 years now. And there's just some uniqueness about that. Yeah, right? No,
of course.
And so anyway, these guys are selling a really interesting solution, but they invested $30 million into this company. The founder, best sales guy, best deployer, best, he was the company, right? And I did a bunch of M&A stuff when I was at IBM. So this is very consistent with some of the stuff that we would see when we bought companies there. But they were like, they wanted to grow from 30 million to 90 million in 36 months. And we were just doing the back of the napkin math on that. So it's like, well, that's like how many of these, I mean, you have a finite set of customers, right? Because you're single-sized your marketplace, which is fine. Got a lot of customers, but you got to close a lot of deals to grow from 30 to 90. Yeah. And we basically said, there's no way. Now we interviewed the CEO before a board meeting. This is what the private equity guy said, like, go talk to this guy. Yeah. Tell us, come back and so we had a meeting with him, and I remember it was on a Friday afternoon. Okay. It was at we spent an hour with him. So it was at 2 to 3. At 3:01, the general partner called. Okay. How'd it go? I'm like, you really want to know? And he's like, yeah. And I'm like, well, here's what we see, right? And so we kind of go down this path of cool solution, not sexy, hard to sell, hard to get a customer to actually like really think about, because it's a long game kind of play. And it was an energy play. And it's like, it's going to cost $1 million, but it's going to take them X time. Right. And there's no any interesting way to like write it off the capital expense over, like quickly so you can recoup it. I mean, there's like, we financial engineer stuff all the time, right? And they're like, there was just no way to get there. And we're like, okay, so the CEO looks like a good operator. Your first sales guy may or may not be the right guy, but it's not always the sales guy's fault, right? It's the company's fault sometimes. And your founder, who is still your best asset, he's getting a little disinterested because he already got the check. Now he's just hanging around because he has to, right? And that's where the systems and the culture and all that come into play, and the predictability of that, it wasn't there. And we would this guy is a passion project for the GP. So he loves this space. And it's like, I don't know if you're going to get there. You might have a 1.3 or 4x return on this one, but it's not going to be a 3x return.
Yeah. And which is good insight, because, that intelligence that you extracted from that meeting was able to equip you to produce the answer you did back to the investor. And so, but that's a great case study. When you think about systems and, workflow automation and KPIs, what do you say to owners and founders that are still trying to figure this out, or even trying to validate, why do I even need that?
So that's good. Like early stage companies, or even later stage companies that are mature, like in a mature business, like the guys that we're working with you guys on, right?
Of course.
That's a perfect,
great example.
Third
generation
business. Yeah. And it's not a sexy product. It's not cool software. It's not, anything like that. But I think, we work with some people that either they don't want to make the investment in that or not. And the system side of it to predict, to just have good evidence, right? That's why they have gauges in cars, and there's there's the gas gauge and this,
and the dashboard.
You got a whole dashboard.
You want to capture.
Right. And you got to pay attention to at least two of those things at any particular time. Sales is one of those, but not having the systems to support the sales, right? So like we were talking about, everybody loves top line revenue, right? And goes back to the full circle here on the systems that are in place to put the revenue in place. There also needs to be systems in place to keep the cost control in place, because you can grow revenue, but if you're growing your cost at a parallel thing, it's a net zero. It's a net sum game. So whether you're selling $1 million or $100 million, you're like no better off. And people don't understand that over time you have to tweak the systems to reduce the cost, to reduce your, whatever. And you learn those over time. And I think people don't have the patience to do the systems, because they just think if they just go out and sell, that's a great one. I invested in a company about 12, 13 years ago now that is in the parking meter lot automation stuff. And it was like
great business, by the way.
Great. It was cool. It's an interesting business.
Because you're renting real estate.
You're renting real estate. Well, and they figured it out that, the interesting thing was like the parking meter business had not changed since the first parking meter was put in the ground in the 30s or whatever, right? And there's still some of those around, right? But what was interesting, what they didn't see, because they should have went public. They said that they wanted to go public in 2018. It's 2026, still not there. What they found is they didn't, and through the evidence that we've probably would have said, like every city that has a parking meter, whether it's a parking lot or on the street, like people are interested, you can automate it, you can do it, you can pay with your phone, all that's good. That takes a little bit of the cost out. But what they didn't realize was every one of these places is a public entity, and it has rules. And it has guidelines that they didn't know about. And so every one of them is different. So if you put a parking meter in, Huntington Beach versus Newport Beach, there's different rules around that that people don't know. So going back into the systems side of it and the research and everything that they should have done, they should have known that, and they could have been maybe gotten ahead of that and maybe pivoted a little bit, which it took them a long time to do. They came out with some new products that are good, but it took them 10 years.
Well, because really what we're saying, and those tuned in here, I mean, revenue doesn't necessarily equal value, right? But when you think about what we're talking about, systems create value because you're building an asset, and that asset's the business,
right?
And so you could definitely enhance that asset by bringing in more revenue. But if, to your point, if you haven't made these measurements to know where you should be prioritizing decision making or changes or advancements,
right,
you could be doing it for nothing.
Yeah. Well, the big lever there was cost of sales, because it took, the math worked.
Yeah.
Because they did a revenue split. That was fine, except for they're like, well, we have to completely rewrite legislation to actually do this.
Yeah.
Well, guess what? How many people you have to get on board with that? A whole bunch.
Yeah.
Right. Yeah. And the mayor just can't make the decision.
Right.
Right.
Yeah.
Even if he wants to, and their model was really good because they could actually increase the amount of revenue per parking place by about 2,000%.
Okay.
It was like, on paper, it was a good business, right? And that's the kind of stuff that it looks sexy on paper until you get to the logistical side of actually the work that it has to implement it. But cost of sales was kind of crazy for them. Another one that kind of hits to that point is customer success. And that's a culture thing, right? And if people don't have good systems for customer success, like, you need to be on top of that, because if you have unhappy customers, they're not going to buy. They're not going to, and they're going to tell everybody, right?
Yeah, absolutely.
Like, no one says, oh, I had the best dentist ever, right? They'll tell you, they'll never say that.
I don't think that exists, by the way.
They don't.
All dentists are equally as painful. No, that's a great point. I want to talk about capital structure.
Okay.
And specifically, let's talk about control.
Okay.
So control in a company, I segment it into two segments.
Okay.
Segment one is operational control.
Right.
Okay. And then the second segment is financial control, is how I see it.
And those are two different things.
Two different things. And so we find that founders, have, call it ego, call it experience, call it, just how they perceive the world.
Right.
They don't like to give up control.
Correct.
I don't like to give up control. I'll raise my hand.
Yeah.
But it's hard.
Yeah.
But in the private capital markets, you have those two segmented levels of control, operations and financial.
Right.
Now, financial control needs to exist for investors that come in, LPs, private equity groups, whatever it may be, because that's their fiduciary responsibility back to their investors.
Right.
But they don't always, nor do they necessarily need operational control. They want to invest in the team that's there. They want to invest in the systems that are there, that are equipping that team to accelerate and to grow and to evolve. But can you talk about kind of how you frame that and how you approach clients when they're considering bringing on capital, and how to really look at those in two segmented worlds?
No, and that's it's interesting. That's why there's a CFO and a COO, and they have different
functions.
They have different functions, right? The financial controls, obviously, those are regulated kind of things, right? So you have to have those disciplines, and people need to know that if I'm going to give you $1, it's not going to get, completely blown up, right?
Correct.
And I'm going to get $1.50 back or something like that. That's what that's the game, right?
That's the game.
Now on the flip side of it, and I think this is where I think founders usually lean probably more to the operational control side versus the financial control side, right? And I think the operational controls really, in my opinion and experience, actually should drive the business more than the financial controls. Because the financial, whether you end up the year, with $1 million or $10 million, it doesn't matter, right? I mean, it matters. I shouldn't say, but it is what it is.
Yeah.
And you've got expenses and revenue and everything to account for, and you got to ticky-tie all that out, right?
Yeah.
Good. On the operational side, though, it's how you deploy that money successfully.
Yeah.
And what systems do you invest in?
Yes.
How do you invest in your people and your culture and the training? Because I read an interesting book. I can't remember the name. I can't remember which one it was.
What was the concept of
the concept was around operating systems.
Okay.
Right. And we have something, we call it chaos, the capital allocation operating system, right? But the operating system model was, and it went through this, there was a whole chapter on it, on sales and marketing. And like the company wasn't doing well. So what was the first thing that they did that they looked at was revenue, right? Because that's the thing that makes everything else happen, right? And nothing happens until somebody sells something. That's something that my first customer taught me a long time ago. But what they said, well, the sales and marketing VP just not doing the job. So they fired them and they get a new one. Well, the new one comes in. It's like, well, the old one was just doing a horrible job. So I'm going to do a better job.
Yeah.
And then they go, it takes 6 months of them finding out where the bathroom is and trying to figure stuff out and understanding the messaging and putting their own fingerprints on it. And then they don't get it done, right? Well, that's not the sales and marketing person's fault so much as it is maybe the company culture, operational stuff, because maybe they weren't getting supported there.
That's right.
Right.
Yes.
And I think building those systems that have evidence-based controls, KPIs and dashboardy stuff, right? So you go, when are you drifting? Right? When are you, because that's a thing that we see a lot with more mature businesses that should be doing really, really well, like should be killing it.
Yeah.
And all of a sudden, they have veered off the road and now they're, the front end of the car is split between a fence post or a, or a tree or something like that. And like everybody's like, what the heck happened?
Yeah.
Well, those systems, whether it's the development side, like in a software company, if it's like the development side, like you can't let those guys indefinitely develop the perfect thing because it will never exist, right? Yeah. Brian and I have I have a really funny story about that. We were with a client of ours in Kansas City, and this is probably about 10 years ago. And one of the developers we were sitting with the customer because we were doing a co-development kind of project with them. They were kind of our beta customer. And we were like, we think it's ready to deploy. And the customer's like, yeah, we think it's ready to, and the developer person's like, no, it's not. I'm like, why not? Because it's not perfect. Yeah. And it's like, it's never going to be perfect, right? And by the way, you just want to keep developing because this is an easy gig for you, right? And those are culture things that's where the culture piece comes into this. Like our company let that happen. Right. And so the project was never done because it wasn't perfect. Right. So that's an example of where I see that on the deployment of capital side. It's like, you need some guardrails. You do need guardrails. And
you need constant feedback. Not a year later, not a month later. You need in reality, in real time, if you could get there.
Yeah.
With KPIs, with those dashboards.
Right. Right. Well, and the interesting thing about this too, this kind of gets back into the Harbor Pilot kind of governance piece of it, right? Is you have your board meeting and that gets called, one of a number of things gets called out in the board meeting, right? 90 days later, you have another board meeting and that's still, and it perpetuates, right? Because no one's really saying no, right? And that's another piece. That's kind of a part of our offering is like being the overboard. Yeah. Yeah. Like analogy, right? Yeah, because you need somebody, because sometimes the board is not made up of the right people. They don't know the business or they're not enforcing the rules. Yeah. And I think that's another part where investors, they want to see a return. They do. But they want to see, how are you going to keep the car on the road, or,
how are you going to stay on course?
How are you going to stay on course? Yeah. Right. And if you don't have somebody that says no, when you're drifting, somebody needs to take the wheel.
Someone does. And so what I'm going to relate this to, in negotiations, right, of these transactions, let's call it, once you can clean your house, so to speak, your systems, your culture, your KPIs and your measurements, that puts you in a negotiating strength or position of strength versus a position of desperation.
Yes.
Because desperation can really come upon you quickly if you are asked questions and you're not prepared to answer them or don't have the data to answer them or cannot articulate the answer that's going to be digestible to those investors.
Right.
Right. And so the cleaner the systems, and I'm sure you'd agree, the cleaner that the systems in the company that have been deployed and kept accountable, the stronger your leverage is when it comes to finding that right capital partner for your business.
Right.
Would you agree?
I absolutely agree with that. Yeah. That that was a perfect articulation of that problem, because that it does, that's just something out there that people just, they miss that.
They do miss that.
Yeah.
So Kent, what would you say for those that are looking for investors or whatever capacity, growth capital, minority equity, majority equity partner, if they're pursuing a capital event, let's just call it that, over the next 24 months, what's your advice to them? Where should they start? Because we talked about a lot.
Yeah, we did.
But what's that first line of intelligence systems that should be ready or prepared or installed into the company?
There's a ton of them. Right? Yeah. So it's hard to pick just one, but I would say that the thing that we see most, the best people have and we go back to the systems, but they measure them often. And so I'm an accountant by degree, but I got into sales and marketing and technology by accident. But I go back to my roots on like measuring things, right? In my first career, I was a machinist.
Okay.
So you measure everything to the twice. You got to do it twice, because whatever you're working on is painful to replicate, and it takes a lot of time. So you waste, that's a whole other story. But probably the measurement systems have to be in place, and there has to be evidence that they're actually executing on those things, which is where people get drift, right? Because somebody can come in and they can look at, like we look at, you look at pitch decks all the time. We look at pitch decks all the time, and everybody's got the TAM, SAM, SOM, especially in the venture side, because that's what everybody wants to be $1 billion exit in 3 years, right? That's everybody's story.
Yes.
Crazy hallucination, fantasy world there. And sometimes AI does that a little bit too. And so you have to have adult supervision on that, which is what we put into this. But when you look at the people that have done well, have had systems in place that they measure and they review, and when they get a little, like they can veer a little bit, and if they don't have an answer for how to get it back on track, because there could be, like you were talking about COVID earlier, right? Like there were systems or there were companies in COVID that absolutely exploded.
Yes.
Zoom.
Yeah. It propelled their business into the future of how we work.
Yeah. And you wouldn't, if COVID wouldn't have happened, they would have been an okay company, but they're in a space that's pretty crowded. Yeah. And especially when you have a company that's in a crowded space, right? Because there's a lot of those types of companies. I mean, like the AI space now. You can't swing a dead cat without hitting an AI company, right? Yeah. But having those systems in place that are actually monitored and measured, they're like looking at the dashboard all the time, right? Well, what happens when the speed goes down or the speed goes, what do you do with that? Well, why did that happen? And if you don't have the discipline to look at that, I mean, I did a lot of tournament fighting, right?
Yeah.
That goes back, well, why did I lose to that guy?
Yeah.
Right?
Yeah.
Or why did I beat that guy? And you figure stuff out, right? But that's one of the things where I think most people miss the mark on, is like they have the controls in place, but they don't actually execute on the controls that they have in place. I think that's one of the biggest things that people.
I would agree with you.
And we pick that up when we start to do the evaluation.
Yes.
Because it takes a few hours to do one of these things, because it's doing so much. But it's looking for those. It's great that you have the you got a CRM system. Mm-hmm. So what?
Fantastic.
Yeah, great. Yeah. Right. You have, like, I'm looking over, there's an SAP thing. I've seen people deploy SAP for millions of years. Like, that doesn't make your business work.
Correct.
Right.
Correct.
And you need to be able to understand how to make the, like, we're talking like we're the car dealer across the street, right? Yeah. Like I have a friend that has a Lambo. Yeah. And he's in Austin. Yeah. And I'm like, why don't you take it out to the Circuit of the Americas and drive it? And he goes, well, I don't want to spend the extra insurance to do that. I'm like, why do you have the car then? Like, if you can't drive the wheels off the car, why do you have a car that can go a couple hundred miles an hour? Yeah. If you can't, because you can't run it
at that point, it's a trophy.
It's a trophy. Yeah. And to him, it's a trophy. Yeah. But I think that's the biggest thing that people miss is they go like, we put in, Salesforce. Mm-hmm. Great. I've implemented Salesforce at a couple of companies, and it's like, until you hold people accountable and have that be part of the culture, that was kind of, full circle, like one of the things we were talking about earlier, I think, right? Yeah. Is the accountability, the discipline, but you also, it can't be like a hammer. Yeah. right?
Kent, how do people get in touch with you to explore working with you and the services that you provide?
Yeah, so pretty easy. They can go to our website, which is kubikai.com, and there's a click there.
Okay.
I'm Kent at kubikai.com.
Perfect.
Brian is Brian, Bryan
Yes.
at kubikai.com. Just do that, and
Awesome.
that's the best way that's the easiest way.
We'll leave some show notes for people to reach out to you both.
Oh, thank you. Yeah.
And I think it's valuable work that you're doing. And as we talked about, having systems is not just about checking the box. It's really about putting yourself and your business in a place of power and confidence when negotiating with capital partners. And when you can do that, you will win. We've seen it time and time again because we know where people lose.
Yeah.
Right?
And I'm thinking that the work that you do, and I think this is some of the complementary thing that we can like we work with you guys on is like, we're really good about identifying those things quickly.
Yes.
And then going back through, like we were talking about, like scoring fundability,
Yes.
right? That's a key thing is like, do you have the systems and are you actually executing the systems?
Yeah, that's right. Accountability side. Yeah. Well, thank you, Kent, for being on. Thank you for sharing your guidance, your wisdom, and the experiences that you have. Because the point has been driven home, right? And those that are tuned in and listening, look, the theme of what we're talking about is if you're building something valuable, but you want that clarity because now you know why you need that clarity, right, Kent?
Right.
Start with the data. I think that's an excellent place to start because what you can't measure, you can't improve. We all have heard this.
We all know that.
But it all
I bet
comes
your
from
book talks about that.
It absolutely does. Absolutely does. So if you want to get your hands on my book, speaking of which, go to inevitableexit.com. And if you're ready to take what you've built, you made the income, you built the systems in some capacity. If you're ready to find that capital partner for purposes of growth, scale, or exit, reach out to us at meritage-partners.com, and we'll be booking discovery calls with you to learn more about your company and see what you're doing. Until then, join us next week for next week's episode, The M&A Guy. I'm your host, Brian Franco. We'll see you then.